Alrighty, hello everybody, and good morning or good afternoon, depending on where you're calling in from. My name is Drew English. I am the program coordinator here at the Exit Planning Institute, and I am joined today with Kyle Madden. He's a partner with KLH Capital down in Tampa, Florida. We appreciate you guys coming out today. Kyle's going to be talking to us about private equity and defining management buyouts or MBOs. Before I turn it over to Kyle today to kind of dive into the call, a few housekeeping notes from myself. First off, first, the webinar is being recorded, so the webinar will be distributed after it concludes today. So just look for an email from me with the attachment for the recording later today. Secondly, we do ask if you have any questions or comments, anything along those lines, to type those in your questions box, which is located on the drop-down menu of GoToWebinar. That will alert myself that there's a question, and I can facilitate those over to Kyle at the end of the presentation. So we definitely recommend interaction and feedback. So please go ahead and type questions or comments in there, and I'll make sure to facilitate those over to Kyle. But with that, I'll go ahead and turn it over to Kyle today. We'll get rolling, and then like I said, we'll distribute the recording later today. So Kyle, it's all yours.
Thanks so much, Drew, and it's a pleasure to be in front of everybody. Good morning, good afternoon. Drew, let's flip to the next slide. So I've probably met a number of you guys that are calling into this, but for those of you that I have not had a chance to meet with, again, my name's Kyle Madden. I'm a partner at a private equity firm called KLH Capital, located down in Tampa Bay, Florida. Little bit of background about me. I grew up in southern New Hampshire in a small town called Amherst. What I do for a day job here at KLH is I am predominantly responsible for working with you guys in terms of identifying and looking for investment opportunities, but then also structuring, valuing, pricing, analyzing, and executing these sorts of transactions and liquidity events. I sit on the board of directors for 3 of our 10 investments right now. I was lucky enough to go to school down here in Tampa Bay at the University of Tampa here in town. And I try and spend my weekends or my off time on a boat, whether that's a motorboat or a sailboat, or on snow skis. And my wife's name is Christine, my high school sweetheart, and happily married to her. Drew? So when I was putting this together, I found myself chuckling a little bit because I don't know that I've ever showed you guys our whole roster or any of the other faces that I work with or my partners. So this is the team. We've got 12 full-time employees as well as a full team of support staff. As what you're seeing is 5 partners at the top. The 5 of us make up KLH's investment committee. Our 2 founders, John Kirtley and Jeff Leck, off to the right-hand side. And then the lower 5 individuals are the folks that are actually getting the real work done. But this is our team, and happy to introduce you guys to everybody. Drew, why don't we flip ahead? So just a real quick background, again, for those of you who don't know of KLH, we are a smaller sized private equity firm within the industry of private equity, right? So while we do manage $320 million across 3 different funds, obviously that sounds like a lot of money. In the world of private equity, it's towards the smaller side. And we did that very strategically. And like I mentioned, we've got 5 active partners, 12 full-time investment professionals. Our most active fund that we're investing in right now is $155 million. So of that fund, we'll look to make, call it between 10 and 12 different standalone investments. We've got about a 35 year track record. We started investing into family-owned businesses back in the early 80s. So that's transacted or transpired into 8 committed capitalized funds over that 35 year track record. And we've partnered up with about 130, a little bit more these days, probably about 140 or so families across the U.S. Since that time. So we've seen a lot of different business models, a lot of success, a lot of struggles, a little bit of everything. But what's most important on this slide is the pie charts across the bottom, right? And we were founded to and focus exclusively on working with family-owned and privately owned businesses, really with an average of about $25 million of revenue. So all of the businesses that we partner with have never had any sort of other financial partner or private equity group before, right? So we're that first group to show them the ropes of private equity. And each business that we partner with, when you look at the portfolio, they're entirely different, entirely standalone, different families, different management goals and objectives, pain points, prior successes, challenges, etc. So kind of zooming out, we exist really to partner with the current owners and likewise management teams, and that's why we're here to talk about today, when they're looking to, say, cash a big check, but accomplish something bigger, right? The money aspect is one thing, but step two is, how do we collectively organize the business so the boss can physically retire, spread ownership to other key employees or key lieutenants, as we like to call them, things like transitioning ownership to the next generation of family. We talked about recaps in a webinar in the past here, and then how to grow and professionalize the business at a rate that management just simply can't do by themselves, right? We had done a deal last year where the owner was actually not looking to sell the business at all, and what we were being told there was, I'm lonely at the top. I don't want to mess things up. I am getting a little bit kind of run dry from being the bank here, and I see a much bigger business, when I'm falling asleep, so to speak, but I want somebody to help me make, top level decisions, who has been there before. And that's a good example of something that we hear regularly across the business owner community, where sure, they want money to accomplish something or a personal liquidity event, but they also see a bigger business than what they currently have, and they need help taking it to the next level. So Drew, if you could flip forward. So here's an agenda of what we want to discuss today, a little bit more about private equity, the basic blocking and tackling, and how we work with companies. And then we'll dive into working around the basic mechanics and definitions of a management buyout transaction, its benefits for the selling shareholders or the current owners, and certainly the benefits for the management team who today is likely to not be an owner, right? And the whole goal there is, how do we facilitate that ownership exchange? So Drew, let's flip, and we'll dive right into understanding private equity and how we work with companies. Next slide, Drew. There we go. So what is private equity, right? Just fundamentally, conceptually, what is private equity? And it starts with the groups, in terms of KLH, the group's thesis and skill set, right? So I mentioned over the last 35 years we've been doing this, but we continue to see owners wanting good, solid monetary value for their business as they look to transition out, but also want to do right by their people. They want to do right by the next family generation. They want to help accomplishing initiatives, often major initiatives, before ultimately retiring, right? There's always something else that they want to do as a final hurrah before the retirement, right? So one can back into the, I'll say, type, or the quote, type of money that a private equity firm needs, given that thesis and skill set, right? Are you going to manage money for an endowment or a pension fund or insurance company or high net worth individuals or a family office money, et cetera, right? Because all those types of monies behave differently, right? So as you're seeing on that slide, you've got your limited partners or your investors at the top, right? That's your supply of capital. Private equity fund here in green, that would be KLH, the actual KLH legal entity. And those monies would flow through KLH and then be invested into each standalone investment, right? So the money here can be used to accomplish really a myriad of different goals in the context of a deal, defined as the proverbial chips off the table. Let's say a partner or maybe two partners wants to retire, in forms of a shareholder buyout. We've done deals to clean up the ownership table, some inactive, some active, et cetera. Again, thinking more shareholder buyouts, or perhaps it's a little bit of both or a little bit of all that. I mean, I think when we look at these transactions, what we are told that the current shareholders wants to do, it typically looks a little different come the day of close when we look to wire that money. So we regularly work on situations where there are multiple different owners. Let's say one wants to stay and grow, one may be undetermined, and one wants to retire, right? And we work with them and you guys to ultimately figure out, what is that perfect transaction, and then we custom tailor that transaction to fit that management team or that business. And it's important to note that the investments shown here across the bottom, they're all standalone. So each company remains its own independent entity. There's no cross collateralization, no centralized accounting, no commingled decisions on one company relative to another. And the money, I've spoken about the types of monies. The funding that we manage comes from all of us general partners at the firm, which is unique in the private equity world, and about a half dozen or a dozen high net worth individuals outside of the partners here at the firm. And they're all, successful entrepreneurs within their own respective businesses. So it's a highly, highly flexible capital base. We don't need to sell at a predetermined time frame. We can do big deals, small deals. We can do deals with customer concentration, vendor concentration, majority, minority. I'll hit this in another slide, but very, very flexible type of capital. And we chose that type of capital just given that thesis and skill set. So we, again, from 50,000 feet, we understand that, we've been doing this a while and that no business is really perfect, right? And that's largely why we exist, right? Because I think if these businesses as we know it, they were started servicing one customer, right? And some of these things that we partner up with and some of the clients that I'm sure you guys have, they still have customer concentration, and that's okay. And we understand that their team, their people are really more than just that. So we wanted to manage this type of capital so that we can be patient and make some decisions based on what's best for exactly that, the people and the business, not necessarily the stereotypical bottom line line item. And further than that, it's just fun, right? I mean, we're all co-investing alongside and we're all stroking checks into these investments. So the owners take us as genuine when we want to provide advice. Drew, next slide. So a little bit of the different criteria across the private equity industry. So different groups have different approaches and models, right? And the maturity of company, we define that as 5 or so years of making money, again, with a minimum level of EBITDA, right? So when we look at that, we're betting conceptually, we're betting that company is making, let's say, X million dollars of EBITDA and will continue to make at least X million, right? That's what we are hoping for. That's what we're underwriting. That's what we're betting on, right? You're making 4 million of EBITDA this year. In 5 years, will you at least be making 4 or 5 million of EBITDA at that time, right? Next is your operational involvement. This is in terms of how we behave in our partnerships. It's hugely different per company need, right? And some of our investments wanted an operational partner, somebody who will work physically in the business on a daily or weekly or monthly basis. And we've done that a number of times. And then on the complete opposite hand, some of our investments are with entrepreneurs who fundamentally just don't want that type of employee or partner, seeing it almost as a boss, right? So we custom tailor our approach. We play both sides of that fence and have staffed our group and our skill set accordingly. The size of investments. I mentioned earlier that we're on the smaller side of lower middle market private equity. So we work with companies making 10 million of revenue up to 100. and pre-tax profit or EBITDA of about $2 million up to $10 million. And our sweet spot is, call it 25 to 30 million of revenue, about 3 to 5 million in EBITDA. So again, in the broad world of private equity, we're small, and frankly, we wouldn't have it any other way. I mean, this is our skill set and our bread and butter. Industries of interest for our shop, we work on value-added distribution, specialty services, and manufacturing business models. We don't typically look at what I would define as like an overly techie focused business or technology focused business or software. And what's interesting these days is it's rare, even when you look at the brick and mortar businesses, distribution, service, manufacturing, it's rare that you're not seeing technology play some sort of role in that business, right? Whether it's an auto billing function or an inventory automatic replenishment system. Technology is becoming a larger and larger part of all of these businesses, but I think philosophically we still try and gravitate to those kind of old school classic American businesses, distribution, service, and manufacturing. And then lastly here, the ownership interest. We started doing minority investments about 2 years ago, defined as less than 50% ownership. So the big thesis there was that we recognized that folks who they still need or they still want a partner for help and growth and potentially want to cash a little bit of a check or some liquidity event, but see too much future value in the upside and in the business to sell off more than less. So we can do both. So again, keying in on flexibility of capital. Drew, next slide. So I'll walk you through real quickly here because I've hit on this, in the previous slide. But this is our investment criteria. So this is a page that's actually taken out of our introductory slide deck that the business owner sees when we meet with them for the very first time, right? So this is a slide where we introduce ourselves in terms of what we're doing. So you're seeing a lot of what I've already articulated here, but distribution, service, manufacturing, and then across the bottom there, we're looking for companies with an established history of making money, clear and sustainable business models, frankly, easy to understand business models. The distribution of fasteners, the manufacturing of pumps, right? It's nothing that's overly techy or sophisticated. And then obviously our model is structured so that we're largely betting and partnering with the people in these businesses. So the people part of this is far, far more important than getting the numbers right. And then obviously we want to look at businesses with a strong growth potential. Drew, next slide. So comically here, and this is kind of an old, private equity comic. Some of you may have seen this, but we'd like to buy the circus, but we want to bring in our own people. So it's kind of the classic misconception of value creation and what makes the business, right? Because particularly in the smaller end of the economy where we play, it's critical for you guys to understand that there's different, when you look across the private equity world, there's different flavors, personalities, structures, et cetera, and really marrying up that right personality in partner with the people in the business is 75% of it, we feel like. And again, I mean, the amount of the money, the transaction, the documentation of the deal is peanuts, right? That's the remaining 25%. So it's just a classic, comic here to illustrate that. Drew, next slide. So we'll talk a little bit about, how we do this and how private equity works within companies. And again, this slide is also taken out from our introductory slide deck to the business owner. So the big idea here, as you guys look at the slide, is growing the equity value of the business together and harvesting that value together. That's the main goal and objective of KLH. So as I've alluded to, the money aspect, again, is only part of the solution, right? The business owner wouldn't nor shouldn't be talking to us if it was just about the money, right? Because there's plenty of banks, plenty of rich people, plenty of folks that are willing to loan them the money. And note that the initiatives here and the relationship between the private equity and the exit planner, right? I mean, a lot of these things or some of these items are projects that you guys are already working on. We get calls all the time where people are, 10% into an exit plan and they realize a liquidity event is next needed. And likewise, we get calls at the very end from you guys saying, hey, we've gone through a plan for 2, 3, 4, 5 years and we're finally ready to transact. So the family dynamics and the politics at the dinner table, so to speak, getting your organizational structure and legal entity rationalization cleaned up. We focus on the delegation and simply overall prepping the business, right? And what we do is physically facilitate that liquidity event. But I'll almost say like that's just the easy part, right? I mean, we also work with the management to structure the business properly moving forward. Grandkids or kids are in the right position to succeed with the right compensation package. Another one is hitting on key sales and operational folks and keeping them satisfied. And graduating the business from, typically when we see these things, we're on QuickBooks, and we'll graduate them to another system with more horsepower that creates a better dashboard for the owner to make decisions. And from a staffing need, oftentimes we've found that these businesses need, I'll refer to more athletes on the bench, right, or on the team. So not a ball hog, so to speak, but the right athlete to put, assists on the board. And a lot of companies struggle with finding good labor, given today the country's shortage of qualified blue collar talent. So we work with the businesses to source sales folks, operational folks, managerial, accounting professionals, etc. So let's move on to the next slide, Drew. So we'll dig in to really learning the basic mechanics of a management buyout transaction and its benefits. Next slide, Drew. So when you look at a management buyout, I mean, what is a management buyout? I think a lot of you, will probably have prior experiences with these, but a management buyout in the lens of a private equity firm is a transaction where one or two or three or more members of the management team, they're typically already managers, who know the business well and are a key part of the company's operations, to buy the stock of their respective company from the owner or owners. And most management teams partner with a private equity firm like ours to finance the purchase, right? And we arrange the entire capital package needed to fund that purchase, including the equity capital, which obviously comes from our dedicated fund. And typically what we're running into here is these management teams have, they've called their rich uncle, they've called the local community bank, and there's a shortage of capital that's needed to ultimately deliver the full purchase price that the selling shareholders have agreed upon. And I want to chat about that at a further moment here, because the purchase price can change vastly depending upon what the seller's current shareholders are actually trying to accomplish. So what are the benefits? You're seeing here the opportunity to create generational wealth for those folks who are really driving the business today, but who aren't owners, right? Our goal is to turn them into owners. And there are ways to create, wealth from a business here, right? I mean, you can make wealth from a paycheck or ownership. A paycheck, as you know, even with bonuses, commissions, et cetera, is finite and typically capped, whereas ownership is not. So ownership, as we all know, is the source of, really we view it as life-changing wealth, and is really only capped by the value of the company's equity. So as the company grows, the equity value increases almost exponentially, and those shareholders can create substantial personal wealth. And the management buyout transaction allows these key managers to become owners of that business where they are already responsible for driving value. I mean, that's typically what we walk into in these introductions is these management teams have already been running these things or have been at the helm for a number of years, but aren't in a position where they own it, right? So somebody else is keeping the wealth that's generated, and that's okay, right? I mean, that's typically what we see. This is a strategy where upon the current owners wanting to sell, we step in to facilitate that liquidity event and get ownership to the management team. So next you're seeing the control your own destiny, right? And so as the owners near retirement, they often stop making the investments required to continue growing. How often do we run into that, right? So as the new owner of the business, the management team calls the shots here, right? They decide where the investments should be made, how to expand their footprint, which new services they should provide, which new products, do you need more trucks? Do you need less trucks, et cetera? And they're ultimately responsible for setting the company's direction and growth trajectory, right? Our role in this partnership is simply to support and facilitate their vision for the company. Next up, that the company stays intact. When one company sells to another, cultures and processes merge and jobs are often affected, right? So an internal sale to key managers here ensures that the company remains an independent entity that can continue supporting its customers, vendors, employing its people, and working towards its original and core mission, for lack of a better word. So current owners who desire to take care of their people and keep their business intact can do so with a management buyout just like this, because the transaction allows the owners to pass ownership directly to key managers who are most capable of successfully taking the company forward. A partner to support your goals, your meaning management. In a private equity backed management buyout, the company gains, obviously a new partner to help tackle initiatives and challenges. So we work side by side with management teams, evaluating and really prioritizing what different growth strategies makes the most sense right now, right? Giving managers that confidence in their decisions and investments. So whether it's implementing software systems, recruiting executives, making acquisitions, not making acquisitions, or responding to challenges, the company now has a vested, experienced partner to really share the load. And as partners at KLH, our interests are fully and directly aligned. Our successes and failures are shared, and we all participate in the equity appreciation we achieve together. And then real quick at the bottom, access to growth capital. Capital investments, as we all know, are required to grow these businesses, right? And absent a financial partner, it's common for owners to fund the growth through a combination of shareholder loans and personally guaranteed bank loans or bank debt. And when you work with us, the management teams will eliminate, said personal financial responsibilities. They don't have to personally guarantee any of the debt whatsoever. And that gives management access to more flexible forms of capital. As I mentioned earlier on, we've got a dedicated fund to support growth equity investments, and with an institutional partner, that company can secure debt capital alongside with us, obviously on more favorable terms than they can by themselves. So our experience, and it's always interesting and unique how this works, but our track record in having a private equity firm at the table gives lenders greater confidence in the company. And so many of the customary constraints, whether it's heavy amortization schedules or growth restrictive covenants, and those personal guarantees are typically all removed. Drew, why don't we flip ahead? So as you've probably pieced together, right? So when we look at these deals, it allows for the reshuffling or restacking of the capitalization table or the ownership table. So at the bottom here, you're seeing the flexibility, right? We could look at doing a minority management buyout, right? Where we buy 100% of the company, and follow me here. We buy 100% of the company, but then gift more than 50% of the ownership to the management team. So KLH in turn owns less than 50% of that business or of the upside. A lot of our transactions look to be majority management buyouts, solely because the valuation that we're running into from the selling shareholders is typically high enough where there's not enough economics for us to gift more than 50% to the management team. The key here is optionality, right? We can custom structure these transactions, so we can cut in the next level of kids or the grandkids. We can pick and choose which specific key employees gets what type of equity and how much. And that's really the key here is we found that the business owners, they have in the back of their minds, 1, 2, 3, 4, 5 key folks who they say, I want them to have the ownership in the business. So again, flexibility and optionality is key here. So on the next slide, or the next couple of slides, we'll want to walk you through a case study here. And Drew will play us a video, and then I'll circle back afterwards, and we'll chat through the case study. So Drew, why don't you play this video? I think for the folks listening, it's a number of minutes. I think it's 3 or 4 minutes long. So we'll listen to that, and then I'll come back online and walk you through the case study. Good, thanks, Drew. Why don't we click to the next slide? So, background to what you just heard here. The company's called Chatfly and Measurement, and it's based in Scott, Louisiana, just outside of Lafayette, Louisiana. And what the company does is today it's a multi-basin oil and gas services company that provides customized measurement systems, measurement and metering systems to both onshore and offshore drilling operations across the U.S. So by strategically targeting high growth regions of the drilling activity in the drilling industry and delivering premier service, this business has experienced really steady growth and an increasing recurring revenue stream, even through that downturn back in 2014 and 15. We had done this transaction in 2013. The price of the barrel was absolutely over $100, but we worked with these guys to play defense, right? They had played offense for a lot of their career. These are 2 young guys, and very quickly we had to put different color hat on and start playing defense there. And that's okay. So as the founders here, think situationally, right, back to a management buyout, as the founders to this business prepared for retirement, they approached Nick and Shane about their interest in buying the company. And as you heard there, they're young, they're energetic, they're perfectly suited to take over, as they had been increasingly responsible for that company's performance, right? And an internal sale to the management team was an opportunity here for the founders to reward its key leaders, Nick and Shane, to retain other long-standing employees besides Nick and Shane, and to create immediate liquidity for themselves for retirement. So for the managers, the purchase was an extraordinary opportunity to turn their, what we refer to as sweat equity, into valuable equity ownership. So they presented a letter of intent to buy the business to the current owners or retiring owners. And to complete the purchase, Nick and Shane needed to, as you heard in that video, they needed to line up financing. And they soon learned the hard way that securing a loan on favorable terms would be challenging, particularly if they didn't want to personally guarantee the loan. So after considering their alternatives, a private equity-backed, buyout deemed the most attractive to these folks. So the team was not merely looking for capital, as you heard, but a partner in the truest sense of the word that could help them make the company better. They were looking for more of a collaborative partner that could help them strategically with internal efforts, making capital budgeting decisions, prioritizing strategic growth initiatives, and then you heard Nick mention it, but implement liquid frameworks, which is a software system to improve their internal processes and provide a dashboard to make better decisions. And more importantly, they needed a partner that would value their personal industry expertise and respect to their vision for the business, right? They were very, very sensitive on who they picked for a partner relative to, how young they were and where they were at in life. And after evaluating, several different private equity firms, they chose us to bring their transaction to fruition because of our breadth of experience and compatible culture and generous equity ownership offer to Nick and Shane. So since completing that buy for Nick and Shane, we have supported the management team in several different initiatives, including expansion into a new territory. You heard Nick talk about a business out in New Mexico, in southeast New Mexico, that we acquired, that we bought and merged in as a what we call a tuck-in acquisition. And then we also assisted the company in recruiting a controller and a CFO, as well as an industry veteran to join the company's board of directors, right? As the price of the barrel dropped, we all wanted more expertise at the table. And then finally, we guided management through the evaluation and implementation of a new accounting and mobile field ticketing system software. So working together, we continue to build upon the company's history and together increase its value over time. So in summary here, young, energetic management team presented with the opportunity to buy the business, but lacked the personal balance sheet to fund the deal. They desired financing from a partner that would not really take over or usurp their vision for the company. And you had two selling shareholders who wanted cash at close, right? And that's the key to these management buyouts, is that we can deliver 100% cash on the barrel, cash at close. They do not need to do any sort of seller financing, et cetera. So the investment structure was that KLH provided 100% of the capital. We arranged the whole package, and post-deal or post-transaction, KLH, we own about 80% of the business, and that's actually less these days because we brought more folks into the business. But Nick and Shane were gifted 20% of the company right out of the gate, free of charge, and they have the ability to earn significantly more than that as this business continues to grow. So as a takeaway here, we've provided the equity capital and arranged the whole package, right? Avoiding the use of seller financing and any sort of personal guarantees. The owners received payment up front versus over time. So they were able to retire and diversify their risk immediately away from the business. We structured in a 20% equity stake for Nick and Shane immediately. And obviously they have the ability to earn more as we could together grow the business. And then we brought on board that in-depth experience and relationships, improving the growth and value for a subsequent monetization event whenever Nick and Shane want to, whether it's retire, but they're still young guys, or exit this investment for a personal wealth diversification for themselves. So we, in essence, we funded that internal sale, preserving that company's legacy, customer relationships, and valued employees. Drew, let's go to the next slide. Hit it again. Yeah, there we go. So let's go into how to identify when an owner company is a candidate for a management buyout. So interesting slide here, but we feel like when you guys are hearing these sorts of things being told to you from your current business owner clients, right? I want to take care of my team or my people. My management team wants to buy the business, just straight up. My management team approached me. I want to preserve the legacy and the culture of my company, but I know retirement is coming. How do I do that? Or want to explore the next chapter in my life, right? But my management team wants to keep growing the company. That is probably, I should have moved that up, because that is typically what we're running into. Is management team has been running the business for, let's say, 5 or 10 years. The industry has shifted. they want to take the company in not a different direction, but maybe an alternative direction or an alternate direction than what that founder may have done with his or her own personal money. So you're running into that point where they're getting up in age, they need to retire, they need to remove the wealth that they've created and frankly sell the business, but you've got a skilled, willing, and capable management team who wants the opportunity to continue growing the company. And then lastly, and we do run into this, but folks just conceptually will not sell to their competition. Competition's always willing to pay more money for obvious reasons, right? They don't need that management team. So they're typically willing to pay more money, but yet a lot of people want to do right by their management team. So consciously, when you're hearing those types of things, that can be when you'll want to introduce a management buyout option to your client. So Drew, next slide. So really, it starts with understanding the owner's goals and objectives, right? And obviously, as you guys are all doing these exit plans and working towards succession plan, getting a better understanding of what the current desires are for asset diversification, for creating a liquidity event, benched against, what does the company need for growth and who is responsible for that, benched against succession planning, right? And typically, when you look at those three categories, you can get a better understanding of what the owner's goals and objectives are. And then as you'll read there at the bottom, every owner has different goals and objectives. A management buyout represents a unique opportunity for the owners to meet their financial objectives today, right? Cash on the barrel, cash delivered today, while also ensuring that the company will continue in its success and that its legacy will stay intact. It's as simple as that. Let's move to the next slide. So when we talk about qualifying for private equity, for those of you who have gone through the CEPA designation, you've probably seen a very similar looking slide here if KLH taught you that piece to the course. But we'll look at the company size, the financial trends, the customer dynamics, the industry, the end markets, and who are you selling into, or what type of customers are you selling products or services to? We're mainly trying to figure out, is there volatility there or cyclicality there? And then what does the competitive landscape look like, and what does the vendor relationships look like, right? Is there vendor concentration? If there is there a contract, or how does the buyer become comfortable with that sort of concentrated relationship? To take a step back, it is not at all rare that we see companies with vendor or customer concentration. It is what it is. It exists. It always has. It always will. When we're looking at working with businesses, that are of the size, right, making 2, 3, 4, 5, 6 million of profit, you typically will have a number one customer that's 20 to 60% of revenue. Common sense answer. I don't think anybody loves that, given the risk that brings to the table for both the current owners and us as the future owners. But that's reality, right? And we're comfortable looking at investment opportunities like that. So in sum, we're evaluating all of these different dynamics, these company dynamics, to look at the sustainability of that cash flow. It's back to that analogy I used earlier of, you're making 4 million of EBITDA today. What is the likelihood that you'll make 4 million of EBITDA tomorrow? And that the higher probability or likelihood for the private equity community means that the more that we'll be able to pay for that business. So let's go ahead, Drew. So we'll dive in now to understanding when and how you guys can introduce a management buyout concept to the owner. So most owners have thought about their retirement and how to monetize the value that they've created, right? But few have committed to a specific plan, right? As we all know, that's why both of us, Exit Planning Community and KLH, exist. So it's possible that they've already considered a sale to the management, but have struggled with its plausibility, right? And we recommend that you express your interest to the owner with grace and humility, and explain how a private equity partnership could provide the capital today and the experience tomorrow needed to successfully complete the deal for the sale. So what is the process, right? So once the purchase price and the terms are agreed upon, and we're almost going to jump to the conclusion, right? So once the purchase price and the terms are agreed upon between Nick and Shane and their prior, bosses or owners, we then got the call, right? So we've been introduced. I'll take a step back here. We've been introduced months before that to some of your clients, where we are to help you guys come up with the purchase price and the terms. And then likewise, we've received a number of calls where that deal, so to speak, has already been baked and processed. So after that, right, let's assume that the purchase price and the terms are agreed upon. The sale, the actual process, takes about 60 to 90 days to close. And key tasks fall into three key activities, right? Due diligence, financing, and transaction documentation. So that process begins with due diligence, where it involves a number of third-party advisors. These are not KLH employees. These are third-party firms and advisors to assess the financial condition, right? A quality of earnings report, market dynamics, competitive landscape, and then the legal condition of the company. And once that process is completed and we, quote, know everything about the business, we'll approach our trusted lending sources to arrange any new debt financing or refinancing that's needed to facilitate the transaction. And then finally, when the lending partners have been selected, the lawyers kind of take the deal from there and get to work, and the documentation of the purchase and the associated financing is papered and finalized. And then what are the benefits, to the current owner? I think the benefits to the management team are rather obvious, right? I mean, they went from zero ownership to now X amount of ownership. That X for us is typically defined as 40% of the company down to 10% of the company. And that's all driven off of valuation and basic economics. But what are the benefits to the current owner, right? Why should they do this? A PE-backed, or a private equity-backed management buyout allows the current owner to fully monetize the equity value in the business at the time of the sale versus over time, right? There is no seller financing. So their proceeds are definitive and final and not dependent upon the company's future performance. That is the number one most leading thing that we get these calls for, is they want to sell the business to the management team, but they don't want to provide seller financing for 100% or even a part of it, right? Economy's doing well right now. Company's doing well right now. I want to sell 100% of my business. I want fair market value, cash on the barrel, cash at close, and I want my management team to participate. That's what we are hearing. So once the owner's educated on the benefits of these types of deals, a lot of guys are excited to see the company's legacy continue in the hands of those who have been important contributors to its success. And then ultimately, our KLH's exit comes together, typically together with management, where we are much more listening than telling when it comes to our exit. That may be in 5 years, that may be in 15 years. But we are waiting for management to call and say something like, hey, did a deal a number of years ago. Company is twice the size that it was 5 years ago or 10 years ago. What is my 40% worth? When we start to hear those questions, we know that they could be interested in a liquidity event, or they could be interested in buying the business back from us. And we have done that a number of times, where we've helped the management arrange a buyout. We've facilitated that buyout. We've grown the business 6, 7, 8 years. They still have gas left in the tank, and we will arrange financing so that KLH is exited, and they then own 100% of the business. So Drew, if you flip to the next slide, there's a number of different ways to introduce the concept or to introduce KLH. We can send you that video, and it's on our website. It's no secret, so you can get it through our website. We have industry white papers on our website for management buyouts, generational transfers, partial recaps or liquidity events. We've got a lot of content on the website for you guys. And then lastly, we're always happy to have a confidential conversation with me or with any of our partners. We do this a lot. Sometimes I know the name of the company on the other end of the phone, and sometimes I don't. So happy to help you guys by jumping on the phone or getting on a plane to see these things come through. So that's all I've got for today, but happy to answer any sort of questions if there's time. It looks like we've got about 3 minutes to go here. So if anyone has any questions, I'm happy to answer them now. If not, my email address and my direct desk line are shown right there, and call anytime. Thanks so much, guys.
Awesome. Kyle, thank you so much. We did have a couple questions come in, so just real quick, we'll kind of touch base with this and then get everyone back into their busy Wednesday here. But if you can just kind of touch base a little bit, I think you had one slide based on this. So what are factors that go into a private equity group considering an investment?
Yeah, so the factors are, I think the word factors to me really means investment criteria, right? So what are the factors of the company have to have, or what sort of characteristics does the company have to have? For us at KLH, and you can actually read it, coincidentally, it's on the lower right-hand side of that slide there, but we will look at companies, really any company that's making at least $2 million of pre-tax profit. So we're looking at the size. Does the profit or EBITDA and the revenue trend and current size match well with kind of who we are, right, and how we're designed? So I mentioned earlier, we're typically 10 million of revenue, $2 million of EBITDA. We're unique in the private equity world because of not only the types of money that we invest with in terms of flexibility, but we've been doing this long enough to be able to underwrite. If it's got customer concentration, that's okay. If it's got vendor concentration, that's okay. If there's salesman concentration, that's okay. If a lot of my point being, if there's a lot of work to be done, that does not mean that we will pass immediately on it. So I would, and I hate to sound like a commercial saying, send me everything, but if you run into a situation where you want me or somebody on our team to quickly look at it, and even if you want to tell us 4 or 5 different bullet points about, here's what they do, here's the risk that I see, here's the upside that I see, we can pretty quickly tell you, if that would be a fit. And if it's a fit for us, great. If it's not a fit for us, I'm happy to think through the Rolodex of guys that I know that I can refer you to.
Awesome, Kyle. Thank you. And then last question that came through is, how does a private equity group value a certain business?
Yeah. So how does private equity value business? We are typically taking a multiple of that EBITDA, right? And the multiple of EBITDA is a variable number that in reality, we've done this so many times that it's almost a gut feel, right? We know if a business is going to trade for 7 times, 6 times, 5 times, 4 times, 3 times, et cetera. But to get to that multiple, we're evaluating the risk in those boxes that we handled a number of slides ago. So we're going to analyze the risk within the customer relationships. We're going to analyze the risk within the vendor relationships, within the sales guys. We're going to try and evaluate the risk of all the different compartments to the business to ultimately tell us, what that multiple should be. So long story short, how we value it is we take EBITDA, we multiply it by a number, typically 4 to 7 times, and that will tell us the value of the business. Now, there's certainly situations where the multiple of EBITDA doesn't work, right? Like, let's say company's making $4 million of EBITDA, but it's sitting on $40 million of inventory, right? So if I apply 6 times to the 4, that still doesn't clear the value of the inventory. So it is definitely on a case-by-case basis where we need to look at the P&L and the balance sheet, but 9 times out of 10, we're looking at a multiple of that EBITDA.
Perfect. Thanks, Kyle. If there's any other questions or comments that you would like to share, you have Kyle's email address there in the middle of the screen, or you could also reach out to me here at the Exit Planning Institute. I'd be more than happy to get those questions over to Kyle. But with that, we'll go ahead and conclude today's webinar. Kyle, thank you so much for spending some time with us and going through this topic that I know and hope a lot of people got a lot out of today. So thank you for that. Everyone, thank you for attending. I will be sending out the recording later today, so just look for an email from myself. But with that, I'll let everyone get back into their busy Wednesday. Hope everyone has a good rest of the week, and we'll touch base soon. So thanks, everybody.